welcome everyone to our event on whether it is time for the UK to introduce a wealth tax. I'm Helen Miller, Deputy Director at the IFS. Given the current crisis, I think it's too early for a fiscal tightening to be started, but not too early to be thinking about what happens to taxes in coming years. There is going to be a debate about whether the UK should have higher taxes. And that will be a debate not just about how we mop up the effects of the current crisis, but also whether we should spend more on public services. And actually, even if we don't change the overall level of tax, there may be calls to change how we raise taxes and, importantly, who pays tax. So this event marks the start of a new project, that will take a detailed look at the idea of a tax on the stock of wealth. It brings together a series of evidence papers from a range of experts in different fields and different institutions, including us at the IFS, to look at everything from whether a wealth tax is a good idea in principle and what it might achieve, to how it would interact with the taxes that we already have on the incomes that flow from wealth, to how we would overcome the various practical challenges of actually implementing a wealth tax. Now, the project is being run by Arun Advani, who is Assistant Professor in Economics at the University of Warwick, by Emma Chamberlain, who is a barrister at Pump Court Tax Chambers, and by Andy Summers, who's an Assistant Professor in Law at the LSE. And the plan for today is that you'll hear short talks from both Arun and Emma. So Arun on some of the facts about wealth in the UK and some of the reasons to consider a wealth tax, and then from Emma on some of the practical challenges that are raised and what's coming next in the project. And we're then going to hear from Lord Gus O'Donnell, who is Chairman of Frontier Economics and formerly the Cabinet Secretary, who's going to share some of his insights on what are the kind of questions we'd need to have answered in order to make a wealth tax proposal viable, and what are the various political economy issues that will, I'm no doubt, crop up. And I'm sure that'll be a great place for us then to start a discussion. So at the end, we're going to have lots of time for questions for the panel. So if you have questions, please add them to Slido. You should have the Slido link either in the email that we sent you with the link. You can find it on the IFS website, on the events page, or on the project page for this video. So wherever you are watching the video, you should be able to find the link. Put your questions there. Please upvote the ones you most want the answers to. And at the end, I'll come back to ask as many questions as I can to the panel. So that's the plan for today. Without further ado, let me hand you to Arun to give you some of the numbers. Arun.
Thanks very much, Helen. So as Helen said, this is a sort of start of a new big project on understanding whether it's time for a UK wealth tax. So to start with, it would be useful just to define what do we mean by a wealth tax. So firstly, wealth. Wealth is the total value of assets that somebody owns, less any debt. So just to make that really practical, for a typical person, that might be the value of the house they own, or more likely half the house they own if they share it with a spouse and jointly own it, plus the value of any savings they have, which might be both cash in the bank, but also the value of a pension that they may also have entitlements of, less, for example, the mortgage that they'll hold on the property. So the net wealth, which is presumably what one would tax, would be the value of the home less than mortgage, and then also any additional savings, any other assets that are large that people have. And a wealth tax is then what we mean by a wealth tax is a tax on the ownership of that set of assets. So it would be saying, what's the total value of wealth? Some percentage of that is what would be taxed by a wealth tax. Now, wealth taxes aren't the only way to tax wealth, and the UK already has other forms of tax on wealth. So just to be clear, you could just instead think, let's tax returns of wealth. So you could think about that as sort of income from wealth. That might be you own shares, and those shares provide dividends, and there's a tax on dividends. Or similarly, you own property that you rent out, and there's a tax on the rent. There's an already income tax that you pay on that. There's also the gain in the value of those assets. So that second property that was being rented out, if it increases in price when it's sold, there's a capital gain, which is the increase in that value, and there's a tax there. So we already have taxes that are on these returns from wealth. You could also have taxes on transfers of wealth. So, for example, when people die, and there's an inheritance tax that's paid as that wealth is transferred on to the next generation. Similarly on gifts, and also on property sales. So if you've ever bought a house, you'll be very aware of stamp duty land tax, which is on the transfer of the home from one person to another. So we already have taxes on some forms of wealth. And so today I want to think about specifically this first kind of wealth tax, a tax on the ownership of wealth, and to think about some of the reasons. I'll focus on some of the reasons in principle why we might or might not think of it as a good idea. And then I'll hand over to Emma, who will talk a bit more about the practical issues that are involved around a wealth tax. So first, one of the big motivating factors, I think, for people in thinking about a wealth tax is, at the moment, or as Helen said, sort of in the coming years, there may be a focus on thinking of additional ways to raise revenue. And some people look at a graph like this, which shows the total level of wealth in the UK over time. And you just kind of see that this wealth is rising over time, particularly in the recent years with a bit of a dip around the financial crisis. So some people look at that and think, well, there's a big stock of wealth out there. And so if one were to tax it, even at a relatively low rate, in principle, there's lots of money there. I would say that's not a great reason to think about taxing things. You shouldn't just say, there are lots of different ways to raise money. When we're thinking about how to design taxes, we don't just want to look for things that are big and say, because it's big, that is in itself a good reason. We should think a bit more practically about what the effects of a tax are going to be and what's the right way to tax it. But one important thing that does come from realizing that wealth, however you measure it across all these different definitions, and don't worry about the precise different versions of this. The point is that whichever version you look at, however hard it is to measure wealth, everyone kind of sees that it's rising. The kind of key thing is that if it's rising, those kind of practical challenges that Emma will talk more about might be more worth tackling because there's more revenue that in principle could be gained from this. So if you think there's some administrative cost to being able to raise that money, it's sort of more worthwhile trying to engage in solving those administrative issues when wealth is rising. But the other thing that is picked up in this graph that is sort of shown by the fact that there are all these different lines with slightly different measures of wealth is that it matters a lot actually how we try and decide both what assets are included, and I'll show you a bit more about those, but also just sort of thinking about there are a kind of sequence of measurement issues that are made difficult at the moment by the fact we don't have a wealth tax. In a world in which we already had a tax on wealth, we would already have a reason for trying to measure what wealth is. Because we don't currently have one, the kind of statistics are much harder to get, and so actually all revenue estimates and all kind of work that's done in this area is made harder by that issue. So another thing that motivates some people to think about a wealth tax is the concentration of wealth. So that's the share of wealth that's held by a particular subset of people. So if you line everyone up from kind of lowest wealth to highest wealth, and then look at what's the share that's held by, say, the top 10% or the top 1%, that's what's shown on this graph. So the black line at the top shows what the top 10% hold, and you can see that it actually declined dramatically. If you look even further back in time, it's basically declined dramatically from the beginning of the 20th century down until about the 1980s, where it stopped declining, kind of flattened out, and then towards the end of the 80s started rising again, albeit very slowly. So the rise is definitely kind of much smaller than the big decline, but that is still something that does motivate some people to think about wealth taxes, because the distributional consequences of a tax on wealth would be a focus up here on these people who are higher wealth, sort of necessarily. But the other thing that this sort of gets across is that if you know anything about income inequality, you would think of, say, the top 1% as holding about 14% of all income. Instead, on wealth concentration measures, they hold something like 20% of all wealth. So wealth is actually more concentrated also than income. And that's again a thing where if your distributional goals are to reduce the concentrations, which is a goal for some people, then that's another reason why something like a tax directly on the stock of wealth is something that people are interested in. But one of the big difficulties with that is that when you look at public attitudes questions, there was a YouGov poll earlier this year or end of last year that asked about wealth taxes and said, would you be in favor of wealth tax? About 2/3 of people say yes. But the version of the wealth tax they were asked about is a wealth tax that excludes main homes and excludes pensions. And you can see from this graph that the biggest asset classes in terms of wealth are the homes that people live in and their pensions. So again, that doesn't mean that one shouldn't do a wealth tax, or that one definitely should do a wealth tax. But it's important to think when we have these discussions about wealth taxes and what they might cover, it's important to think carefully about what assets are included, because the revenue implications, when you look at kind of that first graph I showed you where we say wealth is rising a lot of that rise in wealth has been driven by increases in house prices and in pensions. And so if those are things that people actually would like excluded, that doesn't mean that any wealth tax that would be recommended would exclude them. But if the evidence we have on people like wealth taxes is people like wealth taxes that exclude these things, that has important implications for the total revenue that could be raised from such a tax. This is, I think, one of the most subtle points about a wealth tax. So there are some people out there who have high levels of wealth but low incomes. What this graph is showing you is, first, again, that line I made of people from the lowest wealth to the highest wealth. This is dividing those people up, all of the roughly 50 million adults that we have in the country, into 500,000 sized buckets of what we call percentiles. And so on the right of this graph, we have the top 500,000 people by wealth then the next 500,000, next 500,000. And in each of those buckets of 500,000 people, we're spreading them out and saying, how much wealth do they have relative to their income? So they all have kind of relatively similar wealth to each other. That's why they're in the same bucket. But how does that compare to the income they have? And what this graph is showing is that, a quarter of them, roughly in the top bucket, have a bit more than 10 times as much wealth as income. Have not more than 10 times as much wealth as income. At the very top of the graph, there's almost a quarter of people who have more than 50 times as much wealth than income. And that raises a couple of issues, one of which Emma will talk about more later, to do with how people can afford to pay for the tax. Because suppose I have a very large house, but I don't have very much income. That's all very well saying I have lots of wealth here, but it's not obvious how I then take money in a form that I can pay taxes. And so Emma will talk a bit more about that issue. But the other issue it raises here, and this sort of cuts both ways, is whether this is a kind of fair tax. So at the one extreme, you have people who think of this as sort of as a bug of a wealth tax, which is it creates horizontal inequity in the sense of, you could imagine two people with the same level of income, but one has much more wealth. And the person who has the same income but higher wealth is being taxed more. So some people think of that as a problem, and that's kind of a bug. For other people, in fact, that's exactly the feature that they want in a wealth tax. It's the idea that, suppose that I have a large house that I own outright, and I also have an income, and my income isn't necessarily very, very high. I'm, of course, getting some benefit of owning that house, which isn't being kind of given to me in cash terms, but I get the benefit of owning that house and being able to live in it. My alternative would be I could move out of that home, rent it to somebody, and I could rent a different home. And obviously, we would know that if I did that, we'd have a tax on the rental income I have. If I'm living in that house, there's obviously no direct tax on that rental income. And so for some people, a kind of a feature of a wealth tax, and I think they would like, is the fact that there are these homes that people are living in, and they get some benefit from it, but it's a benefit that isn't being taxed the way that it would be for somebody else who was having to receive an income, pay tax on it, and then kind of use that as a way of getting themselves housing services, finding somewhere to live. Another thing that sort of motivates people to think about wealth taxes, and this is just another kind of key fact about what's been happening to wealth in the UK, is that wealth is increasingly becoming concentrated among older households. Now, it's kind of clear, and in this case, actually older individuals. Now, once it's sort of not surprising that older individuals are more likely to hold wealth. They've had their whole life to accumulate wealth, and they have accumulated it partly because they know that in old age they're not going to be working, and they're going to then decumulate some of that wealth and spend it as their way of kind of living off the savings that they've saved up over their life, because that's what they kind of intend to do. But it's also kind of important because some people think of this as being one of the reasons of having a wealth tax, because of the intergenerational sort of inequalities that we've been seeing over time. So recent work actually by the IFS shows that younger generations at the moment aren't on course to be able to have the same levels of wealth in their older age as current generations who are already older. And so to the extent that older generations partly got lucky because they were around at a time where many of them were able to purchase houses at a time when house prices were rising a lot. And that's not something that will be able to be replicated by younger cohorts, younger generations. There's some motivation for potentially thinking about that, as to the extent that some of that was driven by luck, thinking about what the distributional consequences are. And some people like the idea that the distributional consequences of a wealth tax are to pick up getting revenue from some people who are not currently needing to pay as much tax. So those are kind of some facts about what's been happening to wealth in the UK. I just wanted to point out a couple more things. So one is that taxes on wealth have fallen a lot over time. So there's no sense in which the level of taxes on wealth previously was the right level. But just looking at what's happened over the last roughly 50 years, you can see that in the 60s and 70s and early 80s, getting towards 2% of all wealth was paid away in tax every year. And in more recent years, so from the 90s, basically, that declined. First is that sharp decline you can see in the yellow line around the time of the poll tax, when domestic rates were sort of scrapped in favor of the poll tax, and then sort of a rise as council tax came in. But there's that kind of that new level of tax as a share of wealth is much lower. Now, again, that's not necessarily a bad thing. One thing to note is that a wealth tax is just saying we're going to take away some share of wealth effectively every year. If the return on wealth is declining, and what you think you wanted to tax was the return on wealth, that might be the right thing to do. So imagine a world in which previously interest rates were relatively very high, which is true in the UK, and interest rates are now much lower. Then what people are getting from the wealth that they hold is much less than they were getting previously. And so you might want to be taxing at a lower rate. On the other hand, if your reason for having a wealth tax isn't because you're trying to tax some share of the income, in which case there might be a better way to structure your tax, then you may say, well, look, taxes are lower on wealth. We want to be taking away some larger share of wealth for some other distributional purpose, or because you think that there's more productive uses for wealth, and that kind of putting a tax on wealth encourages a shift towards more productive uses. If you have one of those kind of arguments in mind, then this might say, okay, over time, these taxes have fallen and there's scope for more tax. So I think those are some of the things that motivate people when they think about taxes on wealth. A couple of other issues that I wanted to point out before we get into sort of the practical parts of a wealth tax are, firstly, kind of what I was just picking up on at the end there was there are lots of forms of tax on wealth in the UK already. They're not currently a wealth tax on the ownership of wealth. But when you're thinking about taxes on wealth, it's depending on what your goals are, it's not obvious whether a wealth tax is or isn't the right idea. And so it's important, I think what I'd like to stress is it's really important to think about what it is you're trying to achieve with a wealth tax, or with taxes on wealth, before thinking out the right structure for them, because different kinds of wealth tax have different kinds of tax on wealth have very different properties. Taxes on returns from wealth look very different from taxes on transfers of wealth, look very different from taxes on the ownership of wealth. They have different properties, and which one you want to choose does depend a lot on what you think your goals are. And so I think it's important to think about what those goals are as we have the discussion about whether we should have a wealth tax. And then the other point that I think is kind of crucial and isn't sort of picked up in any of my earlier graphics of what's been happening to wealth is that obviously we know for all taxes, individuals have some likelihood of responding. They don't respond completely. You know, if you increase the tax on beer, we don't think that makes people stop drinking beer, but we do think it probably reduces the amount of beer they drink. In a similar way, we don't think that increasing the tax on wealth will necessarily mean that people will definitely respond completely by not holding any wealth, but you may see some responses. And the question is also then whether those responses are kind of what we call real responses, that is, they change their actual behavior. So, for example, someone decides to save less because there'll be a tax on wealth, or whether it changes their kind of reporting behavior and some of the kind of more administrative issues. And so I think to pick up more on those administrative issues and sort of the very practical points, I'll hand over now to Emma, who will talk a bit more about that.
Good morning, everyone. Well, surveying the wealth taxes that have been introduced in Europe over the last 100 years is a bit like looking at a history of Europe. Wealth taxes have often been introduced in response to a particular political or economic crisis, and no doubt that's why we're discussing it now. But although countries such as France, Italy, Belgium and the Netherlands still tax ownership of specific assets such as land and securities, there are in fact only 3 European countries left, Switzerland, Spain and Norway, that have any form of comprehensive wealth tax. And out of those 3, Switzerland's the only one that raises any serious money. Obviously, those countries that have had or still have a wealth tax can teach us a lot of useful lessons. And certainly in our opening position paper, we consider some of the major design issues, the practical issues that will need to be solved if any effective wealth tax is to be introduced. So the first issue is defining the tax base, and Aaron's already referred to this: what assets should be taxed? What assets are there categories of assets that should be exempt? Generally, countries with a wealth tax do not, for example, tax pension rights, but should owner-occupied houses be exempt, or should they be discounted? Many countries have offered a discount on owner-occupied houses. Excluding them from the tax base might have serious effects on the viability of the wealth tax. What about works of art and other objects of historic, artistic or national interest? Should they be subject to a wealth tax, or should they be exempt if they're if they're available for the public to view? That's the sort of approach that's operated for inheritance tax. And certainly the scope of wealth tax has been a serious concern in countries such as France and Germany, and led to the abolition of a comprehensive wealth tax there, because it was perceived as unfair that some people paid and others didn't. Who should be taxed? Should it be a tax on the household or on the individual? So should all minor children be included in a wealth tax? And if you are going to tax the combined wealth of the married or cohabiting couple, that could raise strong issues in terms of financial independence and privacy, particularly if the wealth tax is steeply progressive. that problem might not be solved simply by giving a lower exemption threshold for single individuals than for married couples. And some countries, such as France, have operated on a household wealth tax. Others have operated by taxing the individual. Certainly in the UK, we have generally taxed the individual separately. We do not tax the household. What about trusts and foundations? How do we stop people splitting their wealth or hiding it? There clearly need to be anti-avoidance provisions to prevent splitting of wealth in trusts. And I guess a general policy should be that no tax advantage or disadvantage should follow from holding assets in trust rather than outright in an individual's name. So you obviously couldn't allow an individual to transfer their wealth into lots of different trusts, with each one allowed a separate exemption limit and a separate rate ban. This would simply encourage fragmentation of wealth between a large number of trusts by individuals. There are a variety of options here. Some of them have been explored in the inheritance tax legislation. One might want a more coherent approach for wealth tax. For example, you could attribute the trust capital to the beneficiaries, but that has its own problems, because what if they are discretionary beneficiaries without a definite interest? And it could also lend itself to avoidance. You may end up getting less than taxing the trust as a whole. Another option is to tax all trusts over a certain value to the top rate of wealth tax with no allowances, which would reduce the incentive to fragment a person's wealth between different trusts. And possibly, and this is an approach that's sometimes followed in Switzerland, that the value of the trust assets in certain cases could be added to the wealth of the person who set up the trust, even if the tax itself is actually paid by the trustees. So there are a variety of options on trusts and foundations, some of which we've already seen operating in inheritance tax and can be developed here. So going on to the next slide, international dimension. I've also already seen some questions on this. Should all UK residents pay? And should all UK residents pay even if they've only just arrived here? That might be rather discouraging when trying to attract talent to the UK. Is it reasonable to charge a person on their worldwide estate, even if their ties here are quite temporary or new? France operated an exemption from wealth tax on non-French assets for the first 5 years after arrival there. Norway, which still has a wealth tax, of course, operates no such relief. And what about non-residents? Well, the inheritance tax model and most wealth tax models have non-residents paying on UK situated assets, for example, UK houses. Most countries with wealth taxes subject non-residents to tax on land owned directly or indeed indirectly through companies to stop people enveloping real estate into companies. And again, we've got some precedent for this now because inheritance tax started doing that from April 2017. Just as we need to think about whether people should pay a wealth tax on all their assets the moment they arrive, we also need to assess whether it's right that someone who has lived in the UK all their life can avoid a wealth tax from the very day they leave the UK to live somewhere else. So should there be an exit tax immediately on departure with wealth tax imposed on their wealth valued at that time? Or should perhaps wealth tax be imposed for a minimum number of years after they've left? So those issues would need to be considered as well. And then we come to the two big assets, valuation, big issues, valuation and liquidity. It was valuation issues that led to Germany abolishing its wealth tax in 1996. And I think that wealth tax does raise particular issues here that are not apparent with other taxes. Other taxes, such as inheritance tax, occur on a once-in-a-lifetime event, such as death. Wealth tax has to be operated periodically, and the same rules and processes that operate for other capital taxes may therefore not work as well here. And valuation is not a cheap or easy process in all cases. The German wealth tax was abolished in 1996 as unconstitutional because there was a lack of clarity about the rationale underpinning its valuations. Land in Germany enjoyed a valuation far below fair market value compared to other types of property. And clearly the closely held family company or valuables such as work of art are always going to be harder to tax and value than a typical residential unit. So things to think about are, should an asset have to be revalued every year? That would be quite painful, but that's the route that France has followed. Or would it be better to operate periodical values say every 5 years. Now, periodic valuations are easier administratively, but they may be seen as less acceptable where the asset falls in value during the 5-year period due to economic crisis. So you might have to have provision for revaluation at the option of the taxpayer. And as Aaron's mentioned, liquidity issues. How do you pay an annual tax out of illiquid assets? The poor granny with the large house and little income is always cited here. Or the potentially valuable IT startup business that currently generates little distributable profits, but could be of very great value to the country as a whole in the future. And countries have come up with different solutions to this. It may be possible to roll up the wealth tax and pay it later on a realisation event, such as death or sale, but the amount of deferred tax could become rather large quite quickly. And then the question is it going to be deductible against other taxes paid on death or sale? Liquidity problems, I think, are certainly aggravated in a more volatile climate where asset prices can fluctuate. The valuation on January the 1st this year might have little relevance to capacity to pay in July for many business owners suffering under COVID. Borrowing, we've talked about the wealth tax being a net wealth tax, but of course the very wealthy could manipulate this by, for example, taking soft loans from banks with whom they have good relations, guarantees from related parties, or perhaps borrow from family trusts. Non-residents could pile debt onto the UK property and reduce their charge. I think here some lessons can be learned from the 2017 inheritance tax legislation, which did provide some, complicated at least, effective, I think, solutions to stop avoidance through borrowing. And France has, in its wealth tax that is now limited to real estate, now allows a deduction only for debt incurred in actually purchasing the real estate, and there are limits of deductibility on high value property. So borrowing perhaps is less of an issue than might be thought. Relationships with other taxes, perhaps also a particular issue for the UK. The UK has a very complicated tax system. We tax some transfers of wealth, but by no means all, and we put inheritance tax on that. We tax some lifetime gifts, not to inheritance tax, but to capital gains tax. How are those taxes going to interact with a wealth tax? Is it just going to be another burdensome complexity in the tax system, which in the end is costly both for the revenue and for taxpayers? Should charitable gifts be deductible against inheritance tax? France does allow this, other countries don't. And it's notable that 2 of the countries that do still have a wealth tax, Norway and Switzerland, do not have a comprehensive inheritance tax. So it may be that in the end, it's better to try and reform our existing system rather than try and impose yet another layer of complexity. Enforcement and administration, well, disproportionately high costs of administration certainly played a decisive role in Germany in terms of dismantling their wealth tax in 1996. So design must take account of administrative simplicity. Although we might say that third-party reporting now enforced across international borders may make avoidance harder and collection rather easier. Banks have got used to collecting an awful lot of data on customers. Transitional rules, well, there could be a long gap between announcing a proposal to introduce a wealth tax and implementing it. So some anti-forestalling measures to stop large-scale avoidance would, I think, have to be considered. In 1909, Lloyd George's famous People's Budget introduced a tax on ownership of land. The nearest, I think, the UK has got to a wealth tax, and that prompted a constitutional crisis with the House of Lords, who lost their power over finance bills. But in 1920, he had to repeal that measure because the land value taxes cost more to implement than they collected in revenue. And he repealed land value tax and returned the revenue collected to those who had paid. And I think progress on implementation was certainly stymied by strong vested interest groups, but perhaps most critically, there was a failure to get to grips with fundamental issues of design and valuation. And that's what this project is trying to do. Over 50 years later, the Labour Party came to power, committed to introducing a wealth tax in 1974. This also failed to materialise, and Dennis Healy commentated in his rather entertaining memoirs, "In 5 years, I found it impossible to draft a wealth tax which would yield enough revenue to be worth the administrative cost and political hassle." And certainly it does seem worthwhile, nearly 50 years on from the 1974 Green Paper, at least to reconsider whether a wealth tax is appropriate, efficient and feasible. for the UK. And in our view, doing this really means a proper in-depth analysis of the design of a tax. And in this area, I guess the devil really is in the detail. The timeline on this, well, we've got the launch today. Over July, August, September, we'll have a series of workshops between the various contributors to the chapters, which include both practitioners, academics and economists, to test out some ideas and to look at some of the practical problems, and also to make sure that the chapters relate to each other. Because obviously a design issue, for example, on the tax base may well have administrative and enforcement issues. In October, the background evidence papers will be published, and then in December, we will produce the final report, and the contributors to the evidence papers will not need to agree with the final report. Indeed, they can actively disagree with it. So they are independent, although obviously we will take on board the comments that they've made. Thank you very much.
Thank you. I'm just trying to get my camera to come on. Doesn't want to do. There we go. Right. Apologies for the delay there. First of all, I spent many decades in the Treasury working on various tax reforms. Nearly always I failed. And that's because tax reform is hard. And there's a very good Institute for Government report called Overcoming the Barriers to Tax Reform that goes into the reasons why tax reforms have been very difficult to implement by various governments of different persuasions, political persuasions. Their number one conclusion is start the debate with evidence, which is the whole point of this project, and hear the pros and cons, and actually, really importantly, as Emma has described in some detail, look at the practicalities. Make sure this is something that will work and will raise, will achieve its ultimate objectives. So you need to be clear about what they are. Now, given that it's hard, I thought I'd start by being optimistic. So reasons to be cheerful. Why might such a reform work now? Well, first of all, we have a clear burning platform. COVID has created a situation where we are moving to a world where debt and deficit levels will be at levels we haven't seen for decades. We're going to have a debate where people will want increased spending on the NHS and things like that. That means that also their views, according to opinion poll evidence, have changed in that when the coalition government was thinking about looking at deficits, they went mostly for spending reductions, not tax increases. People now say they prefer tax increases to spending reductions. That's what they say, but we'll see. So I think the burning platform's a big thing. Secondly, we have a government with a big majority. That matters. You will always have people, MPs, who will vote against various tax changes. So you need to get a coalition on side. Thirdly, I think there's a desire for reform. We've seen that. Michael Gove's recent speech on civil service government reform. They want to change things and they don't want to just carry on as before. So this could be part of that. And quite importantly, you need to do it in a situation where the Treasury and the Chancellor are in reasonably high regard. You know, I always used to say about the Treasury that we were the Millwall of government departments. Everybody hated us and we didn't care, right? At the moment, they are seen as having done well during the COVID crisis. That will be strained as we go into the period of very rapidly rising unemployment, but a popular Treasury can start to get things done. And whilst government isn't exactly highly trusted, I think the Chancellor is probably more trusted than many of his colleagues, let's put it that way. So there's an appetite for change. Why a wealth tax? Well, now, and you've seen some of the evidence particularly on inequalities, and I think a lot more will emerge. The IFS is doing its Deaton review on inequalities in various dimensions. We know that COVID has a very unequal impact. The economic impact is particularly hard on the young, women, those on low incomes. That is going to create a feeling that it's not fair. And you've got a Conservative Party and a Prime Minister talking about the red/blue wall, how to get to forgotten man. We're talking about FDR. So lots of different things, one nation conservatism. So lots of different things suggest to me there might be more of an appetite for this than you might have thought politically from a Conservative Party that came in with a manifesto which basically said no to all sorts of different tax changes. So I think that helps a lot. Quite often, wealth taxes have been attacked because people say they're too lefty. That's what communists do and socialists. Well, actually, we're having a prime minister having to say, no, we're not communists. But yes, we are going to have very big levels of debt and deficits. Yes, we do believe that the state should intervene in issues like obesity. So there is a change there, and I think that's quite important. And in the end, a lot of these things come back to least bad option. So if the debate is put in terms of, well, actually, we really want to increase spending on the NHS, but we don't have any money, then tax increases become more acceptable. I think a lot of this is what I call the chicanery of hypothecation, pretending that this tax increase pays for these things that people love, as opposed to the things they're not so keen on. So it's all for a wonderful NHS, but none of it really funds defence, don't worry, which is always a con, I think. So I think that's important. The risks, I would say, and obstacles, loss aversion. In any package, in any tax change, there are losers and the losers scream. You have here high wealth losers by definition, and they have the capacity to lobby well, as we've seen in various other incidents, and that could be very difficult. So we need, when designing these things, to think about all the behavioral aspects of them. Get the behavioral insight team involved in this very early on. Work very closely with HMRC on the practicalities. Emma's pointed out some of the issues. People will argue, what about the top 1%? They're the ones who've done so spectacularly well in the past. Won't they be able to avoid it? You need to make sure that it's seen as fair. That's crucial. And you'll see that the losers will scream and all the winners will remain silent because they're diffuse and spread out. I did one of these when we had a tax that had become terrible, namely the poll tax, and we were thinking about reform. That involved a lot of, a package of changes, which is important, and reverting to something, the council tax, which we thought was less bad. And we do need to think when we do this, when we set up council tax, we expected it to be something that was revalued very frequently, that would be better than the poll tax, but obviously wasn't optimal by any means. And yet here we are with the thing basically much the same as it was back then. And those of us who are kind of around at its start are amazed and somewhat appalled by that. So we do need to think carefully about, when we set up this wealth tax, making sure it isn't just right for the next 2 or 3 years, particularly if you involve it with something like inheritance tax, might be seen as a good package, but that actually is going to be sustainable over time and be a tax which remains right because of the way it's set up and structured, right? I'm told to stick to 6 minutes and I've gone slightly over. My apologies. Over to you, Helen.
Great, thank you everyone. Well, hopefully given the number of questions we've just raised, you can see why we need a full project to tackle some of these. So questions are coming in on Slido. If you still got questions, please add them and I will keep monitoring. To kick things off, a lot of the questions as I've been reading them are effectively about the economics of this and why we might want a wealth tax. I thought let's jump in and start there. I'll summarise a few of the questions for everyone listening. So a few people, so Oliver and David, are both effectively asking questions about income taxes, so council tax and implicit taxes on rents. Effectively, why can't we just fix income taxes? Question from Alex about, isn't a wealth tax a tax on savers? Isn't that a problem? A question, which our top voted question currently, about shouldn't it depend on what wealth is and whether it's entrepreneurial activity or passive returns or returns to savings? So perhaps I'll jump in on the economics and then hand to you, Arun. I think one way that might help to think about this is that imagine a world in which we could tax all incomes properly. So incomes, whether they be incomes from labour or incomes from returns to capital, like dividends, incomes from rents on houses, implicit incomes. If we tax all of them and we tax them all equally and we tax them at progressive rates we wanted to, then the question would be, why do you want a wealth tax? And that has to be thought about very carefully because, as someone was highlighting, part of wealth is just the returns to savings. If all you were doing was taking people who wanted to save and taxing them more because they were saving, that is a problematic part of a wealth tax, because not only you're discouraging saving, but you're discouraging that person's choices about how much to work, for example. But of course, so that's one case where do you want a wealth tax even if income taxes are perfect? Of course, we have a world where income taxes aren't perfect, and many forms of income are either taxed at lower rates or aren't taxed at all. So there's a question about whether you want a wealth tax as a second best tax, we can't do the best thing, do we want a wealth tax alongside? And then you get to the questions that Emma was raising about how do you think about wealth taxes alongside income taxes and the incentive effects they create? And then one other thing I'll say relating to someone's question is, of course, we're talking about a wealth tax as a permanent thing. We could have a wealth tax as one-off event that says we got taxes wrong in the past, we've got in a situation, let's do a one-off tax, sort of restart the tax system, and then let's do income taxes going forward. That would be an option. So that's kind of how I would think about a wealth tax. But Arun, maybe Emma, do you want to pick up anything from that?
That's covered a lot of what the economics of a wealth tax are. So I think that's picked up a lot of the issues. I mean, I think just to kind of highlight the point that you made, that I think is really important here, and it ties into what Gus was saying. We don't, and we are never going to have a first best, what an economist would call a first best tax system, where sadly, as much as Helen would like us to just implement the Merleys review, 10 years later, we seem to be moving away from rather than towards the recommendations of the Merleys review. So there's certainly a world in which if you put the economists in charge and let us do it the way that we would do it, everyone would have their reasons for complaining about it, but the economists would be happy that they've got exactly their ideal tax system. That's clearly not going to fly. It isn't happening now, and it doesn't look like it's going to happen. So I think there's a sort of practical reality that is, if we're thinking about taxes in the real world, it has to be taxes that people accept, understand, that work given the current package of reforms, and to some extent also are politically feasible. So again, touching on what Gus said, there is an important part of this, which is what's the political economy of it and what can happen. So there are certain things like the revaluation of council tax, which anyone with any knowledge of tax has called for as long as they've been working on tax. And yet somehow it doesn't happen. And so it's clear that there are some of those kinds of reforms that just become very hard. And sometimes actually, as Gus says, a package of reforms that might be something like saying, if there's a world in which we end up coming out with a recommendation for wealth tax, saying this comes in, it works in this form, it removes certain other things that people don't like, that's a package that might actually work and solve certain other problems. You have to think carefully about design. You may still not think that's the best. That may not be there may be a second best design, that's still not that one. And I should just say very clearly at this point, this project is not one that at this stage is saying, we definitely think a wealth tax is a good idea and we're out there to kind of design it in the best way possible. We're genuinely open to coming back with the conclusion that a wealth tax is not a good idea. We're also very open to saying it is a good idea, but in that case, we're almost surely going to say only under certain conditions. And this is sort of the parameter space in which you can work to build a wealth tax that makes sense. But I think there are a lot of design issues in here, but I think one of them that we recognize very strongly is that we're going to live in a very second best world where we don't get the ideal tax system. And so we have to think of it as, how does it fit with an existing tax system? And that may still just mean that ultimately a politician says, that makes sense in my current tax system, but I'm actually going to do Merleys or some other very clever set of reforms. And so I don't need your wealth tax. And we'd also be okay with that.
Emma, do you want to pick up anything on the kind of, obviously if we're on a messy world and they're interacting, those interactions can be horrible, not just from a complexity point of view, but from a distorting choices. And do you want to say anything about the interactions between taxes?
I mean, I think one of the problems that we have at the moment is inheritance tax is a deeply flawed and very hated tax. So that's our tax that we have on transfers of wealth. If we reformed wealth tax so it operated in a better way, then the arguments for wealth tax itself might fall away. So, in a way, a wealth tax might just be a gap to plug for the failures of other taxes. I think, as Gus says, though, reforming an existing tax is quite difficult because there are so many vested interests. As soon as you do anything with inheritance tax, people jump up and shout and say that they are badly affected. So there is a perfect, in which Merleys talked about, ways of improving inheritance tax, collecting more wealth on more tax on transfers of wealth. But the government hasn't shown much inclination to do that since Merleys.
So one of the questions picking up from inheritance tax is that someone's highlighted that complexity in the tax system is regressive. The richest can work out ways to get around taxes that others can't avoid. Won't the wealth tax be the same? Obviously, that's a key problem with inheritance tax. I mean, obviously the work needs to be done, but can we actually be confident that this won't be another tax that the very rich just scoot themselves around?
Well, I think the thing about inheritance tax, it's the reliefs that are given aren't avoidance. They're just statutory reliefs that the government has given into for a number of vested interests. We have huge numbers of reliefs that mean that a lot of the wealthiest people don't pay tax. It's not avoidance in a sense, it's just the government's decided to give those reliefs to wealthy people. I think if you have a wealth tax that's comprehensive and well designed, it should be quite difficult to avoid it. And actually, we've got plenty of mechanisms now to stop that. The problem is that will it be well designed? Will the government give in, for example, to vested interests and offer reliefs? And that's the issue that has really dogged other countries. So, for example, Germany had special reliefs on land. They found it very difficult to do anything about that, so they didn't, and then it became very unfair and was ruled unconstitutional. So,
I guess related to that, so another question is about international coordination. So, assuming the UK government did its best, would we still need to be thinking about international collaboration, coordination to try to ensure that our rich people don't just move offshore?
Well, I've talked a bit about that, and there are ways of, as it were, stopping an exit. I mean, all European countries say they want to tax the wealthy more, but a lot of them do have very particular reliefs for when people arrive. So Italy has a special relief, not totally dissimilar from the foreign dom relief for when people arrive in Italy, which means that they don't pay the same level of taxes as Italians. Portugal's the same. France has certain reliefs. So, I mean, ideally, of course, you'd have a coordinated approach across European countries. That has proved quite difficult, though.
So I've seen you. Yeah, Gus,
yeah.
do you want to come in?
Can I just jump in there? I mean, clearly, as we go through leaving the EU, that's just not on. I mean, and also you have countries like the US, which are highly extraterritorial in their attitude to tax policy. So I think the idea of any international coordination on this will be pretty minimal. I think we need to adopt the kind of things that Emma was talking about. If we're going to go down this route, we need to think about how do we do this from a UK point of view, assuming other countries basically carry on doing what they're doing.
I think picking up on this issue about, obviously, the design is going to be critical. If it's the case that we really do worry that people are going to lobby for exemptions, we could implement the perfect tax first time, but it'll get eroded over time as people lobby for things to be changed. So is it better to have one big tax, like a wealth tax, that we just try and defend, or actually have a series of taxes like capital gains taxes, taxes on housing, taxes on land values, each of which would be lobbied against, but we could sort of defend smaller taxes? I mean, is that an angle through which we might choose one or the other? I guess Emma, then Gus.
Well, ideally, in a perfect world, both, but I can see that you could introduce the perfect wealth tax, and that might actually be easier now than trying to deal with inheritance tax or capital gains tax. There have been innumerable reports on reforming inheritance tax, and nothing happens for a variety of reasons. So, capital accessions tax, someone's mentioned that in one of the questions, that was mentioned in Merley's. These are very difficult taxes to change in practice.
And I would agree with that. And it's this is why you need some kind of package. We would need to think about alongside the losers there'll be from a wealth tax, other areas where we can get lots of winners, perceived winners who can say, actually, this is a very good idea and it's fair. I mean, you'd have to grapple with those notions of fairness, which I think are really important.
Really enjoyed to come in.
Yeah, I think just to the extent that we think of living in a world in which taxes start off well designed and over time get eroded, that's in some ways even more the case for saying probably the taxes that, and we probably all agree that the taxes on capital in the UK are currently fairly eroded from anything that was once good design. Individually, there are parts of them that are good, but there are lots of carve-outs, and every time you kind of fix one problem, like the recent reforms to entrepreneurs relief, you discover, well, there's still 10 million lifetime allowance for investors relief, and so there's another, it's a constant game of whack-a-mole. And so there's a part of it which is perhaps that's the case for saying, okay, well, let's remove some of the already eroded taxes that are no longer working very well, replace them. And it may be that we will have to just accept that in 5 or 10 years time, we're back here having a debate about yet another reform that's needed, because whatever our new beautiful tax system is, that's also been eroded. But I think that it's hard to defend that the status quo is particularly good. And so I think in some sense, it's about trying to find some alternative. In a sense also, if we end up with a menu of alternatives for politicians that say, look, you could scrap them in this form and build this kind of wealth tax, or you could do the Merley's reforms, or you could do someone else's version of reforms, all of which push in the right direction. At least there's then a menu of choices, all of which are better than where we are now, and hopefully one of them appeals to someone in power.
So guys, picking up a few different questions. Somebody's asked, are you going to consider a one-off tax? And I guess more broadly, are you going to be thinking about different revenues that could be coming in from different taxes, and are they going to be credible estimates given the uncertainty we have over how much wealth there is there? Arun, do you want to take that?
Yeah, so let me pick up on both of those. So on revenue estimates, I mean, so very much the structure of this project is one in which we think very carefully about tax design. Some of that will naturally need to think a bit about what sort of thresholds are, because the issues for how you design a wealth tax that has a threshold of taxing all wealth above £50,000 is very different to one that taxes all wealth above £50 million. So in that sense, thresholds do matter for the way we think about tax design. But our goal is here not to do sort of the bit that we think of as the role of politicians, which is to say, do you want a more Swiss style, lower threshold and very relatively low tax rates that are relatively flatter across the distribution, or do you want something that's sort of more US Elizabeth Warren, let's have a tax that starts at a high level and have a very high rate? We're not intending to talk about that part of it. So we will have a paper that's on revenue estimates and distributional implications of a series of options that we'll provide, none of which we think we have any special knowledge or special privilege to be able to say this is the right amount of money you should be choosing to get, or these are the right distributions that you should want. So we're not going to make those choices, but we will set out what are the sort of, what's the range of options. And it might be that when we do that, some of the kind of options we might say, well, look, a Swiss style tax does or doesn't work in the UK because the administrative issues around that are too high or not so high in the UK. And so those kind of things we might judge. That was one question. I've forgotten the other point.
I think it's just about how credible will estimates be if
there's
there's much uncertainty.
And there will also be uncertainty for sure. So we're kind of, so one thing is even in terms of the data work, getting sort of gets a bit nerdy, and I'm happy to chat afterwards with whoever asked this question, but we are doing things to kind of correct estimates for the wealth distribution given kind of information that we can get from administrative records. Those are still imperfect, and it will be hard to get a very accurate estimate. And so what we'll be doing is kind of trying to get a range of credible estimates that says, so this is our range of uncertainty. And again, politicians might make a choice that they want to assume we'll get nearer the lower end of that because that's all they want to be kind of confident that they're doing if they're getting the reform, and they may end up with more. But yeah, we completely acknowledge that there'll be uncertainty in the kind of amounts of wealth out there, and therefore the amounts of revenue you'll raise, because also as well as the uncertainty about what wealth is, there's also uncertainty about how people respond, and therefore how much revenue you actually get in the end once you take into account those behavioral responses.
Great. It's a different type of question, but one that's been voted up to the top. So, and I think I'll ask this to you, Gus. So means tested benefits assess family income and wealth. They do not respect individual financial independence or privacy. Why should the tax system? I guess a broader issue there is that we've tended to move towards an independent tax system that doesn't lump households together. Obviously, benefits are a bit different. I mean, how big an issue is that, do you think, Gus, in selling this to people? The issues that Emma raised about, do you lump households together? Do you have individuals? And, how big a challenge do we think that is?
Yes, I think I remember during Nigel Lawson's time, the move to individual taxation being something about empowering women, and it was a very important step. I think you do have the reality of households and the fact that household composition is changing a lot, and the proportion of people who are married is changing, and all sorts of things like that. And our tax system, I think, is still stuck in an earlier era and needs to upgrade itself to the modern way of living, which is rather more variable and rather more. So I would say in all of this, we need to make sure that the kind of tax proposals we're putting forward take account of and respect people's judgments about the way they want to live their lives, and to try as far as possible to respect all of those decisions and not be biasing things towards one or the other.
Great.
And our tax system does have amazing numbers of biases in it, which I'm sure everyone around the table here, Helen, you could list a very large number of them, I'm sure.
Yeah, there are far too many. So I'm going to pop back sort of to the economics of it, because one of the questions that's been voted up the list is about this idea of, what is wealth effectively at the top, and how much do we know about whether it's entrepreneurial activities versus passive returns versus savings? I guess some of the work we've done, and I'll pass to Arun because Arun's done a lot of this as well, shows that income at the top, a lot of it is business income. It's people who are running their own companies, and often that is basically labour income. So it's kind of the entrepreneurial income. It's not just returns to capital, although there's also a lot of returns to capital at the top. It's also worth saying that even though if it is the case, however, that sort of the returns to savings is kind of small in terms of overall stock, a wealth tax can still be big relative to that amount. So if you imagine two people with £100, one puts it in a bank and gets £1, and one does some fancy entrepreneurial and gets £50, a wealth tax of £5 is huge for that saver compared to his pound relative to the other person. So even if savings are small relative to the stock of wealth, they can still have taxing them at wealth tax rates can still be really important. So we know some things about what wealth is at the top, but we shouldn't get hung up on just what's the big chunk. We should think about how taxing different bits affects incentives. Arun, do you want to add anything on the data side?
Yeah, so I mean, I think it's right that there are lots of different things that go on in the accumulation of wealth, and we sort of need to think about these things separately. And so a couple of the different evidence papers, so one in terms of trying to measure the distribution of wealth, we'll be thinking out where, the form in which that wealth is held. And actually the one that Helen is involved in writing from the IFS side is thinking out the economics of this and exactly these kind of points of why might you want to tax wealth in different forms, and what are the various issues that take place. I think one thing that is sort of important, because I've just seen that question, it is very much both about thinking where does wealth come from, how is it structured, and what are kind of the assets and all those things. That's definitely an important part of thinking out what's going on. But the other thing is also being very clear what you think your goal is. There are different reasons that people propose wealth taxes, and under different versions of those, different kind of ideas of why you might want a wealth tax, you might have different preferences over which of these things are a sensible structure. And so I think it is important to think about that. And so there's a world in which what we could come out to at the end is saying, as a tax purely on efficiency grounds, this may not be the optimum way to do it. But depending on what your equity objectives are, it may be that some people would find this a worthwhile tax. And then that's not a stand again that's one for us to take. But it means that there might be just a subset of politicians who think of it as a relevant kind of tax for them. But I think it is important to think about the different reasons that people are interested in taxing wealth, and what those different goals for a wealth tax mean for whether a wealth tax is the right way to do increases in tax on capital.
I could try and squeeze in 2 more questions. One for you, Emma, because partly I'd like to know the answer and your views on this. So somebody has asked, what are our views on self-valuation of assets? For example, by setting a reserve price on the compulsory auction of assets. So there's an idea by some economists that you can basically get somebody to say, value your asset, but if you tell me the value, you have to sell it at that price to me if I want to buy it, that kind of idea. So what's your view on that?
Well, it depends on the asset, I suppose. I mean, we do operate self-valuation, self-assessment on some assets now. We have a form of a wealth tax on certain properties owned in companies, annual tax on envelope dwellings, and that is a system where you value. It's in bands though, so the bands go up to between 1 and 2 million, and then 2 and 5 million. So you've got a fairly broad range, and so people can insert their valuation within that band and pay the appropriate tax, and it's a self-assessment system. Valuations aren't often, I think, challenged by the revenue. Art obviously is a different thing, saying you've got a reserve price and then you've got to sell it for that amount. It may be a deterrent to avoidance. I think it could be quite unpopular, but it's certainly worth thinking about. I think perhaps art is less of an issue than people think, because there are fairly good ways of valuing really high class art. We have to have that anyway, because we need to know what their value is when we're doing things like national heritage, tax reliefs, etc. I think family company shares and certain other types of assets, intellectual property, will be harder to value, and those are where we need to look at it.
Great. So I'll wrap up with the last question. I guess I'll give to all of you, back to the politics. I'm a little bit depressed about this idea that we can never get a better tax system. We have to just accept the faults. I naively want to do better. So I guess to everyone, what could we do to try to make sure that any tax reforms, whether it's fixing current taxes or getting a new tax, has sort of more staying power? I mean, someone's asked here about how we build cross-party consensus. That could be one way to go. Obviously, I always think explaining what the purpose of a tax is, what it's doing, why it's the way it is a good place to start. But for everybody else, ideas on how we actually make tax policy better and then keep it better. So Emma, let's do Emma, then Arun, then Gus. Sorry, order my screen. Emma.
Okay, well, I am a great believer in trying to get political consensus on wealth taxes, because they operate over a long time. And if you don't, all that people will do is avoid them. And that is exactly what happened in capital transfer tax. People just delayed making their lifetime gifts because they knew that the Conservatives, when they came in, would change the regime back again. And so I think if you're going to have any sensible policy of taxing wealth, you do have to have some sort of national consensus about what is the best way to go. And it's interesting that in Switzerland, although there are differences between cantons, they have got a consensus broadly on wealth tax. And we wouldn't generally think of Switzerland as a communist country, I think.
Great. Arun?
So nothing I disagree with there. To say something different, I think another thing that sort of speaks a bit to the structure of this project is I think it is important to bring together very different kinds of people to work on it, so that we have, economists, lawyers, accountants, people who are working in research organizations, as well as practitioners, as well as former policymakers, to try to then, come at this from different angles and try to solve as many of the problems simultaneously, so that it's not, well, here's the tax that the economists want and it's designed in this very beautiful way, and then separately, here's the tax that the lawyers and accountants think is the best way to kind of solve the avoidance issues, but the economists say, well, that's horrible from a kind of economic incentives perspective. Trying to get all the same people, all these different kinds of people into the same room, or Zoom room in practice, to have a discussion about how you design this, and kind of designing it together very well, I hope means that if we can get a consensus around it, we will hopefully have solved many of the kind of problems that might come up, which often leads to the erosion later on.
Excellent. I'm feeling more optimistic already. Gus?
Well, to be very political, I can't imagine a Labour government being able to introduce a wealth tax without the Conservatives saying they'd repeal it as the first thing they did, right? But we're not in that situation. We are here with a big Conservative majority. So I think it's possible. And I can't imagine the Labour Party saying, well, actually, we're going to repeal this wealth tax. So I think the politics actually for once fits. And we do have Michael Gove saying in his wonderful, strange speech that we want to evaluate everything and we want to clearly increase opportunity for all. So, let's hold them to their words and actually say, well, here's some practical things you could do to achieve your vision of a one nation conservatism.
Good. That's a good optimistic place to end. So thank you to Emma, Arun and Gus. Thank you everyone who's been listening and asking lots of great questions. Hope you're going to continue to work with us on this important area. If you would like to keep updated with this particular project, then you'll be sent an email afterwards, so you can sign up to updates. You can also sign up to updates on what IFS is doing more generally on tax if you're interested in that. But so please do keep engaged, and hopefully, as Arun said, we can build consensus across all the different stakeholders in this area to get a better tax system. But for now, thank you very much.
Thanks, Helen.
Thank you, Helen.